Confirming the audio, and then we'll get started with the content. Okay, so I see that it's like the audio seems to be working. Fantastic. So we're going to go ahead and get started. We have a great presentation today. We are going over how the C corporation double tax applies to a business that's funded via a ROBS 401K. How does double tax apply to a ROBS? So if you're watching on the other platforms, you can please join at mysolo401k.net/mycommunity. That'll get you access to our daily live Zoom links. We go live every day at 1 p.m. Pacific, 4 p.m. Eastern. So for example, we'll be back tomorrow at the same time. Joining also gets you access to our 24/7 forums where you can post questions, see what other people are asking, ask your own question. It's a great way to learn and to share the knowledge. The presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So again, today's discussion is regarding how does double taxation apply to a ROBS C corporation. So we first want to lay the foundation with the ROBS 401k basics, and then we'll get into the discussion. So on that point, what is a ROBS? Well, a ROBS is also known as a rollover as business startup. That's what ROBS stands for. It's a transaction that allows you to use your retirement money to start or buy a business without paying taxes or penalties. There are certain key ROBS requirements. For example, you have to have money that's eligible to be rolled over, such as money that's in a former employer plan or a non-Roth IRA. You must use the money to start or buy an active business. So typically that means an operating company providing goods or services. You must operate the business as a C corporation. And obviously we're going to focus on what exactly that means here today in terms of double taxation. You have to work in the business as a bona fide employee. So typically that means you're working at least 1,000 hours a year. So the steps are at a high level, incorporating, so setting up a C corporation. The C corporation then sponsors a 401k plan. You would roll over the money that you have in your existing retirement account into your new employer 401k plan. So that's not a taxable transaction. It's just going from one retirement account to another. Could also come from a non-Roth IRA. Once the funds are in that new 401k, the new 401k plan is going to allow you to invest in the stock of your new employer. In other words, that C corporation. So the funds would then go from the 401k account over to the business bank account of the C corporation. The C corporation can then use the funds for any legitimate business purpose, including buying or starting a business. So again, if you're on the other platforms like LinkedIn or YouTube, thank you so much. You can join at mysolo401k.net/mycommunity. Gets you free access to our daily live Zoom links where you can post your own questions. We go live every day at 1 p.m. Pacific, 4 p.m. Eastern. It's free to join. All are welcome. So again, to focus on the C corporation requirement, that ROBS 401k funded business must be operated as a C corporation. There's no exceptions. You cannot operate it. You can't operate the business as an S corp or a partnership. It needs to be a C corporation. And of course, that C corporation needs to actually operate the business. It's not just a passive investment vehicle. This is the business. So the C corporation could have subsidiaries, but everything would have to be underneath that C corporation umbrella. So what is double taxation? So let's first understand that concept, and then we'll apply that concept to the ROBS 401k business financing structure. So to understand what is double taxation, let's consider a simple example. So consider a C corporation that is generating income of $100,000. So we're talking about net income, right? After expenses, like your reasonable salary, the salary of any other employees, cost of goods, maybe rent or mortgage payment on the property on which you operate the business, etc. So the C corporation will have to pay income tax at the corporate tax rate before distributing any profits to the owners. In other words, dividends to the shareholders of the C corporation. So on $100,000, let's assume that that corporation pays 25% in taxes, or $25,000, because it's a C corp. It's not a pass-through. So the C corp pays taxes on the money that it makes. Then let's assume that the C corporation distributes profits. So any after-tax profits that are provided to the owners of the C corporation, in other words, the shareholder dividends, are subject to income tax again at the owner's individual rate. So that would be subject to the individual capital gains rate. Could be short-term, could be long-term. So in this manner, the same $100,000 is being taxed twice. Once at the C corporation level, and then a second time at the owner level. So for example, if you own 100% personally of a C corporation, makes $100,000, C corporation pays taxes on the $100,000, say 25%. Let's say it distributes the $75,000 of after-tax profit, then you would pay capital gains tax on the $75,000 that's distributed. So you can see in this fashion, the $100,000, the same $100,000 that's being generated by the business is being taxed twice. So that's just generally speaking at a high level, the concept of what is double taxation. Doesn't mean that this is how it applies to a ROBS funded business. This is just to understand first the concept. So now that we've laid the foundation, we understand what double taxation is conceptually. Now let's determine how that might apply for a business that's funded via a ROBS 401k plan, a rollover as business startup. So a C corporation that is funded via a ROBS 401k plan must pay income tax on the income that it generates. So in other words, that first tax, right, the 25% on the $100,000 of net income at the C corp level. So that applies regardless of whether or not you funded the business via a ROBS, regardless of the fact that you might own some of that company stock via your 401k. But now let's go to the second tax, right? So the second tax will apply differently, however, because one of the shareholders of the C corporation is the 401k plan. So remember that second tax goes after tax profits, like the $75,000 that's distributed. Typically, the shareholders would pay tax on those distributed profits, on those dividends. The double tax on any profits distributed to the owners of the C corporation, however, will be mitigated to the extent that any profits are paid with respect to the shares held in the 401k. So those will be tax deferred, right? Let's say that you own 80% of the company through the 401k and 20% in your own name, right? So it's different than the initial scenario where you own 100% of the C corporation stock in your own name. Here, if you own 80% of that C corporation stock, then 80% of those distributed profits, so like we're saying $75,000, would go back to your 401k. So profits on shares that are held in the 401k are going to grow inside the 401k on a tax deferred basis. So the profits distributed to the ROBS 401k are just like any other gain in a traditional 401k or IRA account, in that the gains grow on a tax deferred basis until they are distributed, withdrawn for retirement. So as you can see, therefore, that second tax that's part of the double tax is not applying to the dividends or profits that are attributable to the shares that are held in the ROBS 401k. So that's the answer to the question. Again, if you're watching on the other platforms, thank you so much. You can please join at mysolo401k.net/my community. Gets you access to these daily live Zoom links. We go live every day at 1 p.m. Pacific, 4 p.m. Eastern. You can also post questions in our forums 24/7. Well, great. Thank you again so much for the participation. And that takes us to the end of the presentation. And until next time, take care.